Welcome to this explainer. Today we're diving straight into the fundamental engines of global finance. If you've ever stopped and wondered how trillions of dollars are just seamlessly routed overnight, or how decades-long infrastructure projects actually get the funding to cross the finish line, you are in the exact right place. We're going to break down the unseen, overarching mechanics that keep the global economy ticking day in and day out, and we'll figure out how to separate the immediate plumbing of the financial system from its massive, long-term growth engines. You know, when we think about wealth, it's super tempting to just picture a giant vault full of stacked coins or a static bank account balance. But for complex financial institutions, wealth isn't just a stockpile gathering dust. It's a highly structural tool. Money is actively deployed into the economy, and exactly how it gets allocated depends entirely on the specific, real-world problems that capital needs to solve. To really understand the global economy, we have to stop looking at money as the end goal and start seeing it as a mechanism for institutional leverage. So here is our roadmap for today. First, we'll establish the two primary pillars of finance. Then we'll peek inside the mechanics of the money market, followed by the capital market. After that, we'll compare them head to head so we understand the trade-offs. And finally, we'll talk about how to actually navigate this complex landscape in 2024. All right, let's jump right into part one, the two pillars of finance. The absolute biggest takeaway here is that every single invested dollar is out there solving a highly specific financial problem. In the institutional world, capital is basically a wrench, and you need the exact right size for the nut. Whether a massive global bank just needs to meet an overnight liquidity requirement for federal regulators, or a multinational corporation needs billions to build a next-generation factory over 5 years, there's a distinct, purpose-built arena for that exact transaction. The entire financial system is, essentially, an ongoing exercise in what we call duration matching. It's all about aligning the timeline and risk profile of capital with the exact nature of the problem it's trying to solve. Moving right along to part two, inside the money market. Okay, so what exactly is the money market? Simply put, this is the financial arena strictly dedicated to short-term borrowing and lending. It operates on two massive, non-negotiable rules: extremely high liquidity and incredibly low risk. Honestly, you can think of it as the global economy's institutional checking account. It's where multi-billion-dollar capital is parked when it needs absolute safety and immediate accessibility. The duration here is super tight, often less than a year, and frequently, literally just overnight. When capital absolutely cannot afford to be locked up or exposed to wild market swings, it lives entirely within the money market. The whole vibe of the money market is steady, incremental, and highly predictable movement. It's definitely not the arena for aggressive wealth generation or placing wild speculative bets to capture massive upside. Instead, it's the steady, foundational heartbeat of the financial system. The absolute priority here is capital preservation and operational liquidity. This is what ensures that day-to-day economic obligations like payroll for huge corporations or daily reserve requirements for international banks are met without fail, no matter what the broader stock market is doing on any given Tuesday. So how does this actually work in practice? The instruments moving through this market are mostly Treasury Bills, commercial paper, and short-term corporate debt, often using repurchase agreements. These are basically bulletproof short-duration IOUs. When a sovereign government or a blue-chip company needs to smooth out their cash flow, they issue these instruments. Institutional investors buy them up, securing a small, virtually guaranteed yield while keeping their cash ready to deploy at a moment's notice. It's essentially the invisible, highly efficient plumbing that keeps the daily economy from totally seizing up. All right, let's switch gears completely for part three, inside the capital market. If the money market is our safe, boring parking lot, the capital market is the high-octane engine driving long-term macroeconomic growth. This arena is engineered specifically for extended investments. Because capital is locked up for years or even decades, investors demand a premium. You're intentionally sacrificing immediate liquidity, meaning you can't just pull your cash out on a whim without facing some massive price fluctuations. But in exchange for having that patience and absorbing that risk, the market offers the potential for significantly higher structural rewards. The capital market is where wealth actually multiplies over the long haul. Now, unlike the smooth, predictable returns of short-term debt, the capital market is all about dynamic structural volatility. You've got intersecting trend lines and rapidly shifting data points that reflect constant, longer-term bets on the future of human innovation. This is where investors aggressively try to price in the future success of entire industries. They're absorbing the inevitable peaks and valleys of global business cycles, all in the pursuit of compounding growth. In this market, volatility isn't a glitch, it's the fundamental feature that makes massive capital appreciation possible. The main players here? Stocks, or equities, and long-term corporate bonds. But listen, beyond the daily ticker symbols flashing on a screen, these instruments serve a massive macroeconomic purpose. They provide the patient structural capital needed for world-changing endeavors. Whether we're talking about underwriting a decade of high-risk pharmaceutical research, overhauling an entire national power grid, or scaling transformative tech across continents, those massive leaps require sustained, multi-year funding, and that's a scale of patient capital that only the capital market can consistently provide. Which brings us to part 4, comparing the two markets head-to-head. When we look at these two systems side by side, it really exposes the core physics of investing and portfolio construction. On one side, the money market gives you that ironclad shield of safety and immediate access, but it strictly limits your time horizon to under a year, which obviously caps your yield. On the flip side, the capital market demands long-term patience and subjects your money to inherent volatility, but it completely removes the ceiling on your potential returns. At the end of the day, the ultimate trade-off in any solid financial strategy boils down to balancing your exact time horizon against your stomach for risk. Mapping this out chronologically really paints the picture. It shows the incredible, continuous journey of capital. And it's crucial to realize this isn't just an A or B choice, it's a seamless spectrum. It starts on the left with the immediate, highly restricted overnight lending of the money market, flows smoothly into the months-long commitments of Treasury Bills, crosses that critical threshold into the multi-year duration of corporate bonds, and extends all the way out to the multi-decade horizons of owning stocks. Where capital actually lands on this timeline is dictated 100% by its strategic purpose. Finally, let's bring it into the present. Part 5, Navigating Markets in 2024. So why does all this matter right now? Well, 2024 has thrown us into a totally unique transitional economic environment, with central banks shifting interest rate policies, inverted yield curves, and just rapidly evolving macroeconomic conditions. The traditional lines between these markets are seriously blurring. When short-term yields in the money market start competing aggressively with the long-term expected returns of the capital market, everyday investors and massive institutions alike have to fundamentally rethink how they use these two arenas. The standard playbooks from the last decade of zero interest rates, they're actively being rewritten as we speak. Whether current headwinds are drawing your strategy toward the short-term safety and incremental yields of the money markets, or you're deliberately positioning to capture long-term structural growth by riding out capital market volatility, intentionality is absolutely everything. You literally cannot build a resilient modern portfolio without a crystal clear understanding of which specific arena your capital is operating in, what its job is while it's there, and the exact trade-offs you are knowingly accepting. I want to leave you with this one final challenge. Take a hard look at your own financial approach, or even just view tomorrow morning's financial headlines through this exact lens. Ask yourself, is the capital in question relying on the absolute safety and immediate liquidity of today, or is it taking a highly calculated bet on the volatile compounding growth of tomorrow? Mastering the constant push and pull between the money market and the capital market is your ultimate tool for navigating wealth generation. Thanks so much for joining me for this explainer, and keep questioning exactly how the financial world works.